The broadcast is now starting. All attendees are in listen-only mode.
Good evening and a warm welcome to all. I'm Ridil Mishra from Corporate Communications team and on behalf of Care Ratings, welcome you to our today's discussion on Can India Prove Its Skeptics Wrong? Sincerely appreciate your time in joining us for this webinar. We are indeed fortunate to assemble our esteemed speakers for today. Dear sirs, thank you and welcome. Dear participant, we'll be having a Q&A session at the end of the end of the panel discussion. In case of any queries, you are please requested to key in your questions, or other option is to raise your hand. That will be in the Q&A session no sooner the discussion ends. Now, may I invite Mr. Ajay Mahajan, Managing Director and CEO at Care Ratings, who would be moderating this session. Mr. Ajay has over 3 decades of experience in banking. He started his career with Bank of America and went on to become the MD and country head of Global Markets Group. He also worked in various entrepreneurial and transformative assignments during his tenure at Yes Bank, UBS, and IDFC. He started his own venture as managing partner and co-founder of R Square Advisors, an investment management and market risk advisory firm. Mr. Ajay is a Bachelor of Engineering from BITS Pilani, a gold medalist in MBA from Faculty of Management Studies FMS, and holder of CFA from CFA Institute, USA. May I request Mr. Ajay to take over the proceedings, please?
Thank you, Mridul. Good evening, friends, and welcome to Care Ratings webinar. Can India prove its skeptics wrong? Now, we have today with us some of the best minds to discuss threadbare the subject and place their perspectives before us. I would like to introduce to you our esteemed panelists in alphabetical order. Mr. Ashvin Parekh, he is Managing Partner, APAS. Previously, Ashvin was Senior Partner in Ernst & Young and headed the Financial Services Division until June 2013. Prior to that, he had held positions of Executive Director of Deloitte, India from July 2002 to June 2005. He's also served at senior positions in Arthur Andersen, PricewaterhouseCoopers, KPMG, and Hindustan Lever Limited in UK, Dubai, Australia, Germany, and the US on partner secondment programs. During his tenure of 33 years, he has successfully completed more than 700 projects. Ashwin's work has been focused on the areas of business strategy and capital expansion with more than 45 transactions in the area of JV and M&As. He was also involved in the formation of 4 new banks in India. Mr. Jaspal Bindra, he is the Executive Chairman of Centrum. Mr. Jaspal Bindra is a seasoned banker with a successful global MNC career of over 30 years. He was previously the Asia Pacific head of Standard Chartered Bank and also worked with Bank of America and UBS. He has vast experience in all areas of banking, including treasury, capital markets, investment banking, and consumer banking. Under his leadership, the Centrum Group has diversified its operations from a fee-based business to a fee-cum lending model with the introduction of housing finance, SME and microfinance businesses. He is currently chairman of FICCI's Maharashtra Council and a governing board member of XLRI. Welcome, Ashwin. Welcome, Jaspal. Mr. R.K. Bansal. He is the MD and CEO of Edelweiss ARC, a chartered accountant by qualification. Mr. Bansal joined IDBI in 1983. He holds more than 33 years of experience covering both development banking and commercial banking, which includes 8 years in top management team and executive director of IDBI. Mr. Bansal retired from IDBI Bank on March 15, 2017. He was the chairman of CDR Empowered Group and a member of top management committees, credit policy, systems, products, ALCO, RBS committee, HR, internal advisory, fraud review, audit committee of executives, and investment committee. He has broad and diversified experience in all functional areas of banking, such as corporate banking, project appraisals, corporate debt restructuring, retail banking, international banking, finance and accounts, resources, recoveries, investments, treasury, operations, etc. as top team leader. His major strength and experience is in resolving stressed assets. He has been handling many of the large stressed asset groups and exposures as CDR, for example, this is all added immensely to his experience. Thank you very much for joining Mr. Bansal and all the other panelists. Now for a few preliminary remarks before we get to our esteemed panelists for their views. Let me start with the economic package. The Prime Minister has announced a 20 lakh package and the Finance Minister followed it up with 5 tranches of reforms that covered the entire landscape of the economy. What was interesting is that it's a combination of supply side measures and medium to long-term reforms to drive the economy. Therefore, one needs to take a broader view of the entire package, and the potential to bring about wide-ranging changes is quite high. We thought that we can call this particular debate, can India prove its skeptics wrong? We need to also take into account the fact that on Friday, the RBI has rolled over its earlier measures, both on the working capital side as also on the moratorium on loans, besides giving us a 40 basis point repo rate cut in the form of a earlier than scheduled MPC committee meeting. Now, what is significant here is that RBI has taken a view that there will be a decline in GDP for the full year this year. That was quite interesting and notable in the governor's speech. There has been some concern expressed that there are limited demand side measures. All of us, I would guess, are somewhat disappointed in terms of more that could have been done on the demand side that's been missing. The first round of supporting demand was in March, and the finance minister mentioned that number at around 2 lakh crore rupees, I'm sorry, largely targeted towards weaker sections, and it was essentially done at the start of the lockdown. Now, there are some measures that have been announced which supplement that initial effort, and NREGA of 40,000 crores additional grant is a good example of the same. Now, if you look at the other measures, what do we see? A big boost for SME from the banking sector with the government backing up, fund of funds for equity infusion, subordinated debt raising for stressed small and medium enterprises, considerable support for the NBFC sector with the government providing comfort, and we'd like to listen to Jaspal on that. Discoms to get funds against receivables, certain other reforms like agri reforms, KCC, housing support, agri infra funding of 1 lakh of crores of rupees, at least that's been the commitment. We're waiting for details. Now, with all of these parts of demand side measures put together, the number can anyway be between 80,000 crores on the lower side to about 2 lakh crores on the upper side, depending on whether you add the 1 lakh towards agri infrastructure and 50,000 crores towards the coal infrastructure, coal evacuation infrastructure that has been promised. But details of those schemes are not yet out. So our sense is that the direct operations of the government are more towards relief and hence sustenance of people and may not be considered to be growth inducing. However, beyond these measures can help growth provided the pieces fit all together, and which means the financial system, which includes banks, FIs, and PSUs, have a role to play. And we are seeing a massive risk aversion. Banks are not necessarily focused on lending at this moment of time, and we'd love to hear panelists' views as we go forward. Therefore, to my mind, one should not be skeptical to the effect if we agree to this perspective, which is that the policies bring about growth over a 1 to 3 year period. It is not immediate that we can expect a V-shaped recovery with government intervention. And hence the debate today that, let's grapple with this issue of what more needs to be done. And most importantly, will India prove its skeptics wrong with all the reforms that have been announced? And I'm sure more to come as we go through the rest of this year. There are lots of questions I have here. How critical is it that the financial system enacts the role set up for them? I talked about banks. Should they be getting into lending aggressively? Should they be feeling more comfortable with the SME guarantees and all the other works that the government has announced? Will NBFCs be able to breathe more freely? Will borrowers get money easily? And so on and so forth. Now, this we can leave to the experts to answer. These are all important issues for us in a credit rating agency, as we have to continuously assess credit risk. And with all these developments in the level of complexity has increased, we are even more watchful in our rating processes at times like this. And every action of every company requires attention than before under these unusual times. Therefore, I do have a selfish interest as the head of a rating agency to also hold this seminar. Now, before we start, I'd like to take an audience poll for which I request everyone present to give their vote on the view. The question goes, do you think the economic package announced will work?
The participants will be getting 30 seconds to respond to this, please. Thank you.
Well, now that we are done with that question, may I invite Mr. Ashvin Parekh to share his thoughts on these subjects. In particular, we would like your view. In particular, we would like. In particular, we like your view on the global stimulus, Indian measures in general, banks' preparedness to deal with the crisis, and will PSU banks lend more than private, etc., etc. And please look forward to your views, Mr. Parekh. Over to you.
Thank you, Ajay. So I mean, I was looking at the kind of votes or the kind of this thing that people have voices that people have expressed. They seem to be equally divided between the two. Let's start with the very first subject that you talked about, Ajay. We talk about the global stimulus programs, and so we've got several countries who have announced these programs, and you can quietly segment them into two parts. One basically are those who are developed countries and who have largely, I mean, their programs are characterized differently compared with the developing countries. So the characteristics of their stimulus program is very different. Let's understand the underlying themes without worrying too much about the numbers and the size of, I mean, percentage of GDP of the stimulus program. Let's look at the underlying theme. The one single underlying theme that comes across, if you study all the global stimulus, it's self-reliance, which means most of the countries who went for globalization earlier have started examining, local and global kind of, but more on local and more of self-reliance. So that's one underlying theme that you can see quite clearly. Associated with this are going to be laws, including World Trade, the kind of organization-related laws, international laws. All these laws in the global, stimulus programs are leading to one thing, and which is we are going to close down our boundaries, basically. We're trying to be as self-reliant as possible. The second important theme that I'm coming across is the support. And the support is mainly towards two parts. One is there's a direct support. A lot of countries, including Japan, US, have directly transferred, irrespective of age and income, into accounts of people, into bank accounts of people, large amount of money to spur the growth, basically. And from the supply side, they are trying to provide a good amount of support to the real economy. That's the second underlying theme that I'm seeing, in the stimulus programs. Liquidity is something everybody's addressing. Ajay. Everybody has actually looked at liquidity, and they've tried to manage the liquidity in their economy, into the system. So that's the third important theme that you see. And the fourth important theme that you can see, and this is coming across some kind of a recognition that they need to become far more efficient, less reliant on a certain group of countries from where these problems have occurred. And therefore, going forward, I'm seeing the world torn into two different sets of people, basically. One set of people who are going to really the developed countries who may eventually evolve as big buyers. They will not be able to do complete self-reliance either on account of their labor or on account of their various other factors, or account of their demographics as well. The age profile, for example, in Japan may not help them, to really boost up their manufacturing in a big way. So you can certainly see that there is an element of efficiency. The world is torn up between buyers and sellers. Sellers are aligning themselves. Perhaps, the last 3 days or 4 days of Mr. Trump's deliberations are leading us to believe. I suppose, where does India align itself? And this is something to do with our stimulus program. And I'll straight away come to the Indian stimulus program. You're getting a clear sense from, I think, the Prime Minister's vision, and then the deliberations the Finance Minister came out with, that India wants to become self-reliant. It wants to boost up its manufacturing. So there is a very high order of, let's say, 4 things that he's promised. We've seen only one of it yet. He's promised reforms in land, labor, liquidity, and laws. And we need to really do a lot in the other 3 areas. With the exception of liquidity, we need really more clarification from the government, policy makers, in the area of land reform. Land reform, particularly land allocation for real economy and for services. These are the 2 things that we need to, and also for those who want to put capital in India, those who are coming from outside. There is a certain hint to people who are focusing on China to move to India, I mean, clearly, or such other countries to move to India and making India more friendly, which means laws, international laws are going to be very important out here. The second important theme is a huge dose of reforms. And I can see substantial reforms in, corporatization, in opening up, sectors to private sector. So there is a huge package of reforms, So this is, as you rightly said earlier in your opening remark, Ajay, is going to strengthen the supply part of it. And I'll turn to the demand part a little later. The direct transfer or the direct benefit transfer, DBT, is not as large as one would have expected. And this is one area, which I find a certain order of, call it a weakness or call it a vision. It's a weakness or it's a vision if it's somehow or the other, it's allowed to be made true. A lot of reforms need to go into, including regulations, to make this happen. What will really happen? I suppose in areas like health, education, there's a crying, even real estate, there's a crying need for proper regulations and proper regulators. I suppose the government will start addressing some of these issues. That brings us to an important observation that we all make. There is a substantial order of dependence on the Indian banking system. A huge amount of dependence on Indian banking system to roll out the entire program. Now, let's try and understand, this particular part a little more in detail. Somewhere along, you're also seeing an element of efficiency. We heard the Prime Minister talk about quality, particularly in the reference of exports. So I suppose there is an element of efficiency in these sort of announcements that you can see. How does it materialize? How will it happen? Is something I'll quickly touch upon. Let's turn to the last bit of my deliberation, and that is the package, the Indian package. The Indian package perhaps is characterized, the banking one is characterized by a few things. What we are trying to do is we are trying to create a certain amount of, money flowing into the economy through a borrowing program for MSMEs and for various sectors. So instead of direct transfer, we want the MSMEs, and small industries. And in fact, there is soon going to be a representation from the large industries as well, to say that, look, in order that the small MSMEs can really do well, they need to supply to somebody, and that's where the large corporates will also need a certain amount of liquidity kind of support, basically, to set up their factories again. But that's one important theme that you're seeing in the Indian part. The question that comes to our mind is, if there is an overdependence of banking, will banking really roll out the program well? Let me first look at private sector, and see whether private sector will roll it out well or otherwise. Before I go into private sector, I thought somewhere along the government has actually, one government after the other, in the last almost 2 decades, have failed to open up the real cooperative banking sector or the grassroots sector. Small finance banks, in terms of size and shape that they have not really been able to garner any amount of respectable market share as yet. They're coming up. They have a role to play in the economy. The so-called RRBs, the rural regional banks, they don't know whether they're competing with cooperatives or they don't know whether they're competing with their parent organizations. They are in a confused state at this point in time. They are expected to roll out the law. Okay? They are expected to roll out the entire agriculture credit, and are they really? This is a huge question mark that comes to our mind, basically. Private sector. Will private sector banking take this as an opportunity, particularly with reference to the guarantee offered by the government? I'm very sure Indian private sector banking, I call the next decade as a decade for Indian private sector banking. And then the reason why I believe so is that whilst the public sector banking will keep itself busy with several other issues, and I'm going to touch upon that a little while later, private sector banking will certainly try and look at getting into this on a commercial basis again. They'll purely do it as a business proposition rather than a stimulus program. They will certainly examine the guarantee part of the contract very closely, because all the guarantees, including crop insurance, the Prime Minister Fasal Bima Yojana or various other, let's say, programs, if the insurance companies are stuck up with getting money from the states, the guaranteed money from the states, and if the private sector banks are stuck up with getting the guaranteed monies from the government, then or getting more questions rather than money, then in that case, they will certainly not participate in this. So they will try it out first, test the waters, and if they do it, they'll do it on commercial terms, clearly. So that's a private sector banking. Let's quickly look at the public sector banking. Where are they at this point in time? I suppose in the last 6 years, we seem to have done far too many things with our banking than it was actually necessary. We started with the Jan program, expected banks to, so the bank's bandwidth was focused for almost 8 months on that. There was a huge target set out by the Prime Minister, and it was a good program, without recognizing that the focus on recovery got lost. And we ended up with a huge problems on NPS. There were 3 other programs, that we got into GST, so the banks had to wait. We got into, so these reforms, when they were rolled out, the banking bandwidth was unnecessarily keeping itself busy on different priority items. Basically. It did not focus on recovery. It did not focus on monitoring the accounts. And we have a huge NPA, which suddenly sprang up and before us in 2017-18 period. Then came all the reforms associated with bankruptcy law, and there also, once again, 2016, when it was rolled out, we got an impression that by 2018, and that is RBI's estimate, we would end up getting 50% of our recovery, from this, so-called banking, the bankruptcy kind of code mechanism. The actual numbers are far, far less than that. If that wasn't enough, in 2019, we introduced the consolidation program. Now, the consolidation program is really keeping the bank's bandwidth. 11 banks, are involved with in some form or the other with this process, and the bandwidth. With the exception of perhaps State Bank of India, which rolled out its plan because it had a mother organization kind of a concept, and now Bank of Baroda has some chance with some amount of things being they were ahead of the game. They got a little more time compared to the others. Where are the others? Will they complete their integration and then get into rolling out the stimulus program? Even if they get into stimulus program, even if they do proactively identify MSMEs, which is a very doubtful proposition, because I think Indian banking, public sector banking, is characterized by what I call supply, demand-led, which means the bank managers sit there in their branches. It's totally demand-led. The customer has to walk into the bank branch. Do they know their customers well? Let's pose that question a little later. With all that backdrop, to expect public sector banking, to really roll out this program in an effective manner, it can be done. I'm not a skeptic at all. I've always believed that it can be done, but I suppose correct frameworks will have to be put across. To give you a small example, if NBFCs know their customers very well, if they're closer to them, please use NBFCs. Let on a back-to-back, the loan exposure lie with the bank, but let NBFC, at least work in identification, in getting the credit or getting the borrowers closer to the credit and give them a role, please. But I suppose a very proactive approach, a very, very, very well worked out risk management program, and a very well tightly monitored admission, monitoring and recovery process could really help, the whole stimulus program, to really make it more effective. Where is the hope? The last word I would say is, the biggest hope is Indian business. India is a land of entrepreneurs, and they will find a way out. If they find that they get good buyers, either in Europe or in US, I'm very confident in my mind that they will really find funds, They'll work with the banking system. They'll somehow or the other, they'll really do that. The system is to make sure that it does not roll out more red tapes, and red carpets everywhere. It has to really roll out simple methods of getting there. So to answer the whole thing, a very well thought out vision, an extremely bold stimulus program, excellent in terms of its vision, in its terms of its coverage. You cannot, there's no element of doubt in this program. How well will it be executed, is $1 million question. Those are my submissions, Ajay.
Ajay, you are on mute.
Ajay sir,
I'm so sorry. I didn't want to disturb, but then one forgets. Thank you very much for very well covering the aspects on both the global side as well as how the Indian government and the Reserve Bank of India and Indian banking system is gearing itself up to deal with the stimulus. I have a bunch of questions, but I'm going to hold on and give audience the first choice, and therefore leave some time for them. And and should those questions get covered, great. Otherwise, I'll get an opportunity to ask you later. I think before we move to Mr. Jaspal Bindra, I want to do another small poll here. And the question is, will overall flow of funds to borrowers increase after all these announcements? Your answers, please. You have 30 seconds. Yeah, while we get the results of the poll, 66% say yes, 34% say no. That's not bad. It clearly shows that there is optimism in our audience, and that's very encouraging. Let's move to Mr. Bindra. If I could ask Mr. Bindra to give his views on the package, on what's there for NBFCs, and also how does he see, or how do you see, Mr. Bindra, the effectiveness of the stimulus measures announced so far? Again, I'll have questions, but I'll reserve them. I want to hear your thoughts on the broad theme.
Thank you, Ajay. Let me start with a global financial services picture and how India sort of fits within that or stands against that. And then I'll quickly move to the NBFC sector within India. I think there is a strong unanimity building across the globe that we are headed for a low growth scenario across the world. And what that entails is a drastic reduction in banking capacity. And the logic, I mean, several commentators have made several points on why they support their thesis. But the three that seem to stand out for me, which seem to be beyond dispute in this new wave of disruption that they're talking about, which seemingly will be forceful and pervasive, etc., and is likely to unfold over the next few years. The foremost among that driver of disruption was technology. The combination of machine learning, blockchain, artificial intelligence, quantum computing, all of this put together, 3D printing, together could not only create new scale opportunities, but for those that don't keep pace with them, it could engender huge risks for them. So that is one sort of view which I subscribe to, and I think the world is thinking that way. The second is the fundamental demographic changes across the globe. Aging populations in advanced countries as well as emerging countries as big as China could hugely stress social, political, and business systems. And I It's very visible and likely to happen. I think this is a mathematical thing, so there is little room to disagree on this one. The third and the final point that I felt was also very valid is the persistent low growth coming from low inflation, maybe tipping into deflation, from near zero and maybe even negative interest rates. This is a real possibility for many advanced countries. And I think, if I'm not mistaken, the term used by some experts was Japanification. Because I think, so whether people will go for a full-scale Japanification or will it be a Japanification light, I mean, that is the only dispute. But I think that is, and that of course, again, will have huge consequences for growth and profitability of the BFSI sector globally. We've seen that in Japan, the top leading banks of the world for several decades were Japanese banks. For the last 2 decades, they are nowhere to be counted among the top. So clearly, that is what it is. I think that if we turn to India, I actually hold the view that we are, rather than have a drastic reduction in banking capacity, we are going to have a massive expansion in banking capacity. And I say that to counter some of the things that are being globally accepted as home truths. First is, India is among the fastest growing fintech markets in the world. India has ranked the highest globally in the fintech adoption rate together with China. Digital payments of the value of 65 billion in 2019 is expected to continue to grow at a CAGR of 20%, at least till 2023. And one of the biggest catalysts for rise in consumption has been technology, because the reach has increased, access to credit for borrowers has increased, processes have become more efficient. You can now get credit within 20 seconds, 2 minutes, 4 minutes, 6 minutes for even small ticket items. So clearly that is one that is right. I think on demographics, there's no argument. We are a contrarian. I think by 2030, India is expected to have the largest working age population in the world of 96 crores people. 962 million is the census prediction. And we will not only be a very large domestic workforce, but I think we'll be the largest exporter of skills around the world. And I think our most productive decades are ahead on that basis. And I think if I look at the third thing, I don't believe that with this demographic, with the low per capita consumption, that we are going to head for deflation. We are probably in the moderate inflation zone. We'll likely remain in the moderate inflation zone once we come out of this COVID's immediate impact. And I think it is very difficult with the high savings that are there in India to see a zero or a negative interest rate. I don't think so it's politically viable for this country. And so I think Japanification is not a likely situation for India. So I just wanted to start with saying that India will definitely prove the skeptics wrong when it comes to the BFSI sector in terms of where it is headed over the next decade. When it comes to the NBFC, I think the coronavirus freeze is just the latest headwind. I think we've had a series of them, a multi-year storm that's dragged down consumption and seen India lose its world's fastest growing major economy status. I think financial institutions are set to become even more cautious just when credit is the most needed to keep the economy going. And this pandemic has hit India's economy just as the green shoots were emerging. So from a timing perspective, it's all wrong. I think banks and mutual funds have become very wary of lending to NBFCs due to the rising risk perception, and both in the sector. but also largely in the aftermath of the ILFS crisis. And we've seen ongoing credit downgrades since then. I think the NBFCs are facing a severe liquidity crunch. NBFCs in turn are not lending sufficiently, and that reduces credit flow to the economy, which limits economic growth, but worse, causes borrowers to default. So the slowdown is real. I think that is the key point. And the government and the regulators have to take note of this and act fast, because time and time again, I think banks and other authorities in the government, for their own selfish interest, keep saying, no, everything is fine, the system is stable, and everybody is okay. I think that is not the reality on the ground. I think we're headed towards a huge consumption collapse, and that, if not arrested, will eventually result in an economic recession. Moving on to the reforms now, that is what I think Ajay wants to hear about. The necessity for the loan moratorium and its most recent extension now is absolutely understood. I think it is essential, it's the right thing, livelihoods come first, all of that is well understood. But it is a major negative for all NBFCs, because this would further delay the overall collection and recovery procedure and stretch the total liquidity cycle for all. While moratorium granted on loans varies from 20% to 100% across NBFC, depending on the customer segment, the product line, etc., the moratorium provided to NBFCs from banks is negligible. So as a result, the NBFCs will focus on conserving their liquidity to honor their own payments. Now, moving on to the specifics, the aggregate allotment of 75,000 crores to NBFIs, which is NBFCs, including housing and MFIs, comes as a life-saving liquidity booster shot, in my estimation, especially for those that are in the lower investment grade category. However, as Mr. Ashvin mentioned earlier, the details and execution of the scheme would be key to ensure that the funds reach the eligible borrowers. The 30,000 crore special liquidity scheme is very positive, as it directs liquidity where it is most required. The partial credit guarantee scheme is a bold move, as it allows banks to renew lending to MFIs, NBFCs, HFCs, particularly with low grade ratings. But it is important not just to look at the size of the fiscal response. I think we also have to clearly look at its design. The national lockdown would slow down domestic activity for sure and impact cash flow of NBFCs. Once the lockdown is released, the recovery can only be expected to be gradual, depending on the ability of the workforce to get back to work soon, restoration of supplies to intermediaries, and of course, demand for the output. Therefore, the full magnitude of the economic impact of COVID will be only understood over a course of time. The last thing I want to say is that NBFCs have been written off more than once in the last 20 years, like several times. In 2000, NBFCs contributed to much less than 5% of the credit disbursements per year. In the year ending March 2018, we don't have the exact numbers, but in excess of 25% of the credit in that year, 17-18, came from NBFCs. So clearly, there will be another day, and this will pass. But for now, it's great. Thanks.
Yeah, thank you, Jaspal. I really appreciate the entire coverage and the depth in which you sort of took us through. India's relative competitiveness in the globe is intact. That India will not go the Japan way. There's far more going for India. But you also brought to fore some very important points relating to immediate action that the government needs to take to make sure that we don't go down that much in terms of consumption and GDP, that it becomes that much more difficult to come back on. So thank you for your comments, and I have a few questions. Again, I'll reserve them. Before we go to Mr. Bansal, let's do a quick poll once again. Question coming up on your screen. Will the lower rated NBFCs be able to get more funds through these guarantee schemes? Lower rated NBFCs. You have 30 seconds. Here, our audience is not that optimistic. 62% think that lower rated NBFCs will continue to struggle for liquidity. Only 38% are positive. All right, let's may I invite Mr. Bansal to tell us about what he thinks about NPAs in the banking business pending. As we all know, that banks have been struggling with NPAs for a while. For the last 3-4 years, ever since the NBFC crisis started. And the IBC code has now been, fresh cases for IBC has been deferred by a year. And also that the banks are being given more time for resolution. 6 more months are being added for existing stressed assets wherever resolutions were expected. So over to Mr. Bansal. He's an expert in this area. He heads the Edelweiss ARC. I've already gone through his introduction. Over to you, Mr. Bansal. Very keen to hear your comments.
Thank you, Ajay. So let us start with, first of all, NPA situation in the banking. And as we are all expecting that because of COVID, we will have more NPAs in the system. So up to now, we have been talking of 10 lakh crore worth NPAs in the system. And if we add about 4.5 to 5 lakh, which is technically written off by the banks, then it is about 15 lakh crore. Now, at least my personal view is that because of COVID, we'll end up having another 4 to 5 lakh crore of NPAs, in spite of maybe a moratorium of 6 months given by RBI. Now, how to resolve these NPAs? And as Mr. Ashvin also said, the banking system is today struggling with the somewhat indecisiveness or decision making is an issue. And if you really see the June 7 circular also, not many cases have happened under that circular. Now, IBC getting postponed, so I'll come to that later. So the problem today is mostly in decisions for resolution of these stress accounts. One problem was the consortium financing, and we had number of banks. It was very difficult to make them to agree to one point at one level. One good thing is because of mergers of the banks, the number of active banks at least has come down from about, we used to have a number of cases where 30 banks were there. Now you will find at least only about maybe 10 to 12 banks which you have to resolve. So that's one positive point. In June 7 circular, my view is that RBI most likely, though up to now banks are saying we don't know how the cash flows will flow, so we can't do restructuring, but at some stage the restructuring will come into picture, and that is the only way you can avoid too big a figure to, I think, NPA level. NBFCs have their own, of course, concern, though Jaspal ji has told that and he knows better. But there will be NPAs even from our non-banking space. And certainly there it becomes more difficult to do restructuring. Now, so what to do in such circumstances? I feel one moratorium is only temporary measure, but it also hits the NBFCs indirectly. And then RBI has to come out something of one-time restructuring, which it allowed in 2008. And that will at least, I would say on paper, avoid the NPA system for banks. May not be for NBFC because NBFC have to follow Ind AS, and it doesn't help much in the NBFC space. In the banking space, certainly it will help. The NPA level will not look that high, but finally it is the only book figure. So more than the book figure, you have to find a resolution to all these cases. So one thing which is there is banks have to give additional working capital or additional money, which I think, as we were discussing, it's becoming difficult. Though in SME space the 20% limit can be given, but for the larger cases some banks did give 10%, but it is becoming case to case. And when it becomes case to case, similar to moratorium to NBFCs, it becomes very difficult actually for the banking system to take that call. And then you will end up having only the larger groups or big cases getting some money, and those who really need are not really getting that money. And banks are really afraid of, let's say, what happened earlier in the earlier round of restructuring, that are we will be blamed for just, evergreening type situation. Now, there was another view, like the resolution, whether we can do it through bad bank. Now, this bad bank idea has been discussed a number of times, and if I really see from my IDBI experience, that when we created in 2004 SASF, it was nothing but bad bank. So IDBI's assets were transferred net book value from 13,000 crore gross to 9,000 crore net, and that 9,000 crore finally we could realize there at about 5,000 crore, and the balance 4,000 crore, perhaps another 1,000 crore or so can be realized. But that was exactly a bad bank idea. Now because every bank down that time, of course, because of DFI system, more assets were such in IDBI. But then today you have almost every bank in those project finance type loans. So the only advantage which I feel from bad bank is aggregation. So as I said, many of the banks, they don't come around to take a common decision. In that case, if you transfer all these assets to bad bank and all the banks transfer it, so at least the decision making can be faster. So one problem of your decision making goes away. Like say, as I was mentioning in June 7 circular, only one case has gone through the oversight committee, which was, I think, one NBFC, and finally that didn't also happen because RBI didn't allow the change of management in that company. So not even a single case has gone through that route actually. Now, in that circular, just because I'm talking about that circular, at least 2-3 things need to be seen. Section 29A, people feel is applicable even at June 7 circular. That fear has to go away. Secondly, I think rating agencies also have become too cautious, so they hardly give those investment grade rating for restructuring of sustainable debt. I think that has to be either removed or rating agencies have to be given some confidence. And third, basically point is that banks have to be forced, or it has to be mandatory to sign the ICA. As of now, there is a big confusion whether ICA is mandatory for signing at all. Though RBI has clarified at some point, but many banks are not signing even at the first stage, including in one case ICA didn't agree. So it is not only small banks which are not signing. So it is like it is again becoming a case to case thing. So I think that circular, if we remove these 2-3 things, the restructuring can become a norm and the restructuring can be done. We have to understand one thing, I think, in IBC also. Section 29A, whatever purpose it was, I mean economic, political or messaging, I think it has achieved its purpose. So a lot of cases which big corporates at least have got that message that you can lose the company. But now is the time, and I have seen in IBC, except those 5-6 big cases, hardly any case has given some good value through IBC. And the time taken is becoming too much. And many of the schemes, what is happening as lenders, we are either being forced, because IBC is only one-way street. You can enter, you can't exit. So either we are being forced to accept suboptimal resolution plans, or it just goes into liquidation because banks don't reach or lenders don't agree to plan. And under liquidation, whether you call it liquidation and as a going concern, or liquidation as a piecemeal, or through a resolution plan, finally you need a buyer. So when you don't have the buyer, you will not get that value. And that is why the government finally realized that there are too many cases in IBC, and on top of this COVID came. So they just wanted to see two things in the matter of suspension of IBC. One, there should be a competition, because otherwise if you try to sell these assets today, during the next 6 months or 1 year, you will get a very low value. I think government wanted to keep that market value at least picture, and then we bring a competition. But my feeling is in smaller cases, of course, MSME they are trying to cover, but then there also they have thrown a googly by putting both the definition together of investment as well as the turnover, which was not expected. So now that covers a very small percentage. And let me tell you, hardly any MSME case was filed in IBC except by operational creditors. So financial creditors have not filed cases against MSME. So what are you trying to save actually? Basically mid-corporate cases. And in mid-corporate cases, unless 29A goes away, I think banks will not get that value which they are expecting. More than the promoter, I don't think those assets you can get strategic interest. You can have an SR Steel or Bhushan Steel or Binani Cement where you can get strategic interest. But otherwise, you will not get. I have seen number of steel cases which are very poor valuation we are getting, or it just goes into liquidation. So finally, out of first 12 cases also, Ajay, if you really see, and hardly we have got plan in steel cases only. 5 steel cases and 1 JP Infra, because finally you had assets there. Other than those 6 have almost gone into liquidation. So even by the valuation perspective, it depends on the asset quality. So if asset quality is good, maybe you will get a value. But then, sorry, my feeling is, so 29A has to be relaxed. Other than willful defaulter, maybe we should relax that, and that will help in restructuring under June 7 circular also, and even otherwise. So this bad bank idea, the other problem with bad bank is a conflict of situation actually. Finally, now banks are saying that earlier they realized that ARC don't have that type of money, and even government doesn't have that type of money, that if you have to transfer assets worth 4-5 lakh crore, even 15% you require at least 30-40,000 crore, even if you sell at 50 cents. So now they are talking of transferring a nominal value of 100 crore in all the other cases where loans have been written off or fully provided for, or in the other cases net of provision. So that itself is only about 15,000 crore, which I think government may or may not subscribe. But then the challenge will again come there. You can do a warehousing there finally for some time. The advantage would be that at least banks can take a common decision because the loan has been transferred. But the disadvantage, or whatever say shortcoming, which nobody is clarifying, is who will invest money in AIFs, who will buy these assets finally. So at some stage you will still need a strategic buyer, or you will need a fund who is ready to buy the asset, which can happen even outside bad bank scenario. So I don't find much benefit in that. You already have 28, 29 ARCs, which are nothing but the bad bank. But we have a lot of regulatory challenges in ARC today. 15% is compulsory. Banks don't sell under SR structure. They want cash to ARCs, and ARCs, no bank lends to ARCs. So when then you have removed already the provisioning benefit to banks, which they used to get. Even for NBFCs, India sometimes create a problem whether it is a true sale or not. So the sales to ARCs under SR structure is not happening, because that is the only structure where ARCs can work. If ARCs have to buy in cash, then it is a stress asset scenario. So I was just talking to someone that if I add all the stress asset fund in this country which are talked or which are in existence today, or including ARCs, the total money available will be hardly 25 to 30,000 crore, out of which 10,000 crore, let's say, is already invested. So even if you take 15,000 or 20,000 crore and you take a pricing of 30 cents, still you can buy assets of only 60-70,000 crore. While we are talking of NPAs of 8 to 9 lakh crore or more than that. So ARCs or funds are also, it is not possible. So my feeling is banks have to do restructuring. We have to believe to some extent the existing promoters. We cannot brush them away and paint them with the same paint everywhere, that all are chores and all are, all have diverted funds. It could have happened in some cases, but that you can try to take control by removing the willful defaulters. So my feeling is ARC sale under SR structure, restructuring, tweaking the June 7 circular, and partly bad bank maybe for other cases where you are not getting any proposal today and you want to warehouse these assets, like say power plants. You try to sell power plants today, you may get only 1.5 to 2 crore per megawatt. That too, if you get easily. I am seeing cases now we are hardly getting 2 crore per megawatt, but it is worth 5 to 6 crore per megawatt, and you need power after industry starts. So I feel that there the warehousing concept or bad bank concept can work. So these are my initial views. Thank you.
Thank you very much, Mr. Bansal. Very enlightening to hear your views on the NPAs. Again, there will be some questions, hopefully, to you, as I have a couple ready. With that, I want to, before we open the session to the audience for questions, we have done all the discussions till 5. We have 30 minutes more for Q&A. But before that, I just want to ask one last question of the audience, which is, by how much do you expect NPAs to increase by March 2021? Your choices are more than 5, 3 to 5, less than 3. 30 seconds. This is incremental over what exists. Right, so more than 5%, 61%, 3 to 5, 35%, and less than 3 is only 4%. So it very clearly tells you that the market is expecting more than 5% incremental NPA, and it's quite in line with what Mr. Bansal mentioned as well, that he expects about 5 lakh crores of NPAs, and that roughly on a 100 lakh of total credit is indeed 5%. So with that, thank you very much, panelists. I've thoroughly enjoyed your comments and learned a lot from them. Let me now open this up to the audiences to ask questions. Over to you.
Yeah, thank you, sir. Dear participants, now we begin our Q&A session. You can please click raise your hand option in your panel. Alternatively, you can key in the queries in the slot provided. I repeat, you can either raise your hand option in the panel, or you can key in your queries in the panel provided. My colleague Urvisha will help me putting forward your queries. Thank you.
Good evening, panelists. This is Urvisha. We have a question from Mr. Sailesh Parekh, and he's saying, what is the impact of extended moratorium on the small NBFC and MFI?
If the panelists get the question, Urvisha, there is some noise on the call. Could you repeat the question again, please?
Surely. The question is, what is the impact of extended moratorium on the small NBFCs and MFIs?
Okay. Jaspal, may I request you to take this?
Yeah, sure. I think the answer is pretty straightforward, because the moratorium for the smaller NBFCs and MFIs are a high percentage given their nature of their business, and because they are in turn not entitled to an automatic moratorium themselves, they clearly are going to feel the pressure, liquidity pressure of this. So a lot depends on how quickly the government schemes that have been announced kick in to fill this gap. I think if that works well and it fills the gap, then clearly it will take care of the immediate liquidity situation. The other issue is, the longer the moratorium continues, the more difficult to get borrowers back to their EMI plan because their cost goes up, their monthly EMI also goes up because of the interest cost. So I think all in all, it's as I said before, it is a good thing. It's the need of the hour for people who have been shut down for so long. But clearly for the NBFCs, particularly the smaller ones and MFIs, it's going to be a challenge.
Ajay, may I take up this question?
Yeah, yes, please. Yes, please.
Yeah, see, I mean, the way I'm looking at it is, see, for the last 4 quarters now, if you examine the monetary policy, I mean, the policymakers have been saying one thing, and the regulator has been saying, quite a different tone altogether. And let me articulate my thoughts.
Yes.
Now, you find that, let's say, about 4 quarters ago, after the monetary policy, there was a clear mention in the policy itself, and also in the question and answer session, the governor did respond to one of the questions, saying that from the systemic risk point of view, I mean, there wasn't any COVID at that point in time. We had only systemic, that is economic related, let's say, issues of non-payment. And he said that 75% of the assets held by NBFCs are with about 50 large NBFCs. And therefore, from the systemic risk point of view, the necessary liquidity measures and the measures associated with flowing the credit from banking to NBFCs are more addressed towards this 75%, that is this first 50 NBFCs basically. Now, time and again, you're getting a sense that the inability on the part of both the policymakers and the regulator to segment the NBFCs, and to clearly say which are the NBFCs, which really need a strong amount of support from the point of view of consumption generation at the grassroots level, is something, there is absolutely no study, there is absolutely no recognition of that. So, I mean, from the policymakers who keep on listening to that, but you're not getting that. So that was one. Second is, my mind goes back to 2011 and 2012 moratorium. Because of the moratorium, you saw the impact on the banking balance sheets way down later in 2014, 15 and 16 period, and suddenly, so one generation of government is passing on the problem to the next generation of governments. And the regulator seems to be a silent spectator of this entire issue, basically. There has to be a recognition of NBFCs, there has to be a proper segmentation of NBFCs, and there has to be specific program associated with segments rather than generalizing them by their size, and by their shape and things like those. So somewhere along, I think that reform is yet awaited, I would say.
Thank you very much. Actually, I had this question at the back of my mind. I wanted to ask you both. Maybe if I can just extend the question further to say, should moratorium have been customized to different client segments? And I think you answered that. Ashwin, we know your thoughts. Maybe if Jaspal can quickly comment on this. Can we treat a corporate borrower that's, let's say, a multi-fold, multi-thousand crore company in the same league as a salaried or a non-salaried individual who has to pay his EMI on a housing loan or a small asset financing he has done, or a consumer durable good he has bought at, let's say, some consumer store, or a credit card receivable? Should these not be segmented at least at that level? Jaspal, your thoughts?
So I think, the situation is in the immediate, on a temporary basis, so grim that I think the more people who this extended to is probably better for the system to come out of it. So I don't think so we should prioritize between them. But clearly for the intermediaries, it has to be a back-to-back. Otherwise, it's very difficult. And the problem will be that this will result in disputes, and it will result in litigation, and it will hold things up. And the people who genuinely cannot pay will just not pay, irrespective of whether the moratorium is available or not. So
That's right.
in effect, you're anyway offering the moratorium along with the legal case.
So that makes sense. Okay. Thank you for answering that. Back to you, Pradul.
Yeah, there are a couple of hands raised. I have a query from Mr. Pankaj Kapoor. Mr. Pankaj, I have unmuted you. Can you please go ahead with the query?
So thank you for the opportunity to ask the question. My question to the panelist is, considering the COVID environment and with the confidence in the economy is very dismal. What are the suggestions in which the demand can be revived? How can we raise that confidence level and boost up the economy? There is something which already government is doing on the supply side. How do we do that on the demand?
Yeah, can I take that?
Yes, please.
Yeah, so you see, I mean, right from the very beginning, I suppose, if you examine all the announcements made by the government, you're getting a clear sense that the government, I mean, and including the regulator, both, are more keen at this point in time to pump in as much liquidity into the system as possible on one side to make sure that the systemic risks are addressed, basically. In case of demand, what is expected, and this is where I suppose the COVID situation and the lag impact, that is how soon will these reforms or this stimulus program will start taking its effect, is a major question that is coming up in everybody's mind. Let's look at the flow as envisaged by the government. They envisage that the MSMEs will borrow from the banking system. The banking system will open up the funds. MSMEs will resume their commercial and economic activities. The economic activities resumption or beginning will end up with incomes at the grassroots level, and then the demand or the consumption will grow. So it is, I mean, in as much as we talk about transmission of interest rate reduction, there is going to be at least between a quarter to 2 quarters of transmission of income flowing into the economy to boost consumption. Now, it's a very indirect approach. It can happen. It can certainly, even after a quarter or so, really start putting income in the hands of, let's say, people at the grassroots level, provided this program of 3 lakh crores, another 50,000 crores, overall it comes to almost about 5 to 6 lakh crores. It has to go to the grassroots of the economy. It cannot remain at a certain point. It has to flow to begin with. And thereafter it has to generate income, and then it has to generate consumption. I suppose the government is waiting for further more announcements. I'm very hopeful that the question of short-term consumption will sooner be addressed by the policymakers. And I pray and I hope, that something like this comes up very fast. Because it's beyond just putting liquidity, it's beyond making banking system, provide funds to the borrowers and waiting for the borrowers to really go to the banking system. I suppose it has to be in the form of some direct benefits or some transfers. I'm waiting for that. I hope and I pray that something like that comes up in the next part of the program. Maybe the government is not used up the fiscal kind of strength it has. The fiscal deficit after all these numbers look, still to be in the region of about 6 to 7%. So I would say if they go whole hog and do some more of direct benefit transfer, then I suppose we could have addressed that question. So those are my thoughts, Ajay. Mr. Kapoor, those are my thoughts.
Thank you.
Right, so there's a raise hand option from Mr. Sunil Mehta. Mr. Mehta, I have unmuted you. Can you please go ahead with the query?
Yeah, we just wanted to understand, like rating agencies, like how they are gearing up for assessing post-lockdown scenario, and what would be their top 3 priorities?
So this question obviously is for me, and I would say that at this moment of time, this is a very disruptive event that has happened. There are regulations both from Reserve Bank of India and from SEBI that have been announced in the form of multiple circulars. The rating agencies in the past have sometimes been criticized for being too slow. Now the regulatory interventions seem to point that the rating agencies should not be overly jumpy in calling for defaults through this period of post-COVID, or while we are going through the transmission still continuing quite aggressively. The guidance from the regulators has been to not specifically call for defaults wherever they happen entirely due to COVID-19 reasons. So we are mindful of some of those regulations. At the same time, the fundamental job of a rating agency is to provide through the cycle ratings to clients. And while no rating agency can be necessarily prepared in living through the cycle ratings, assuming a 9 sigma, 6 sigma, whatever you call it, event like a multiple round of black swans that we have seen now. The fact is that for each sector, we are, as rating agents, going into the details of how deeply the sector has been impacted in terms of its liquidity, in terms of its business revenues, in terms of its existing leverage and capability to service that leverage over longer periods of time as opposed to just the next 3 months or 6 months. It's very important to take a slightly longer view of things than to be totally, disappointed and depressed with the fact that at this moment of time, most toll roads are collecting nothing. Electricity consumption in the country has come down. If you start looking at all of these numbers and start taking them into your DSCR projections, for the immediate future, the outcomes will be very negative. The rating agencies are mindful of that, and they are trying to take a slightly longer term view of how the company's capability to withstand this shock exists. Those that have adequate liquidity, particularly let's say in the NBFC sectors, if you have 4 months, 6 months of liquidity, those NBFCs will obviously be very different from those that have only 1 month of liquidity to go through the difficulties that are being posed by the market. So I think that's the generic answer to your question. And then there is very specific to each sector, and that's hard to cover right now. But I hope that I've broadly answered your question.
Yeah, thank you very much.
There's one more query from the line of Mr. Sunil Parekh. Mr. Parekh, I am trying to unmute you. Can you please unmute and pose your query, please? Yeah, Mr. Sunil Parekh. But Vishal, any query from
you hear me?
Please? Yeah.
Yeah, can you hear me?
Yeah. Please go ahead, Mr. Parekh.
Okay, I just wanted to thank all the speakers and raise my question. I am from Ahmedabad and I look after the Gujarat division for FICCI and for the Gujarat Chamber of Commerce. And what we are finding that at this difficult juncture of banking, we are getting a lot of inquiries from people who want to de-risk operations from China. There have been 3 inquiries just day before yesterday and yesterday on the issue of wanting to buy things like 2 lakh of pumps and about 17,000, so about dollars. So that is about $17 million worth of switch gear from Gujarat for Korea, Japan, and some things in USA. These medium and large scale industries are finding it very difficult to raise capital at this stage to be able to capture the opportunities that are coming from China as part of the anti-China sentiment and the need for diversification. What do the panelists have to suggest by way of solution for funding of such brilliant ideas, which is in fact going to lay the foundation of a stronger India tomorrow?
Ashwin, you may start, please.
Yeah, so you know what, I mean, that's a really good question. See, as a practitioner, I'm also getting, these kind of requests now, and I'm trying to see whether there would be funds available, anywhere, to be very honest, who would be interested really on a collective basis, on an aggregate basis, to really put some money into this. Now, let's go through your thought process. Your point is absolutely valid. That's the vision all about. The vision actually takes a clear position, saying that we are going to be sellers of the future global market, basically, which means we need to really look at buyers, European markets, Japanese markets on account of their demography, or we would look at, let's say, the US market. We need to. So I suppose we've not talked about this. We've talked about liquidity. We've talked about working capital. The government has to start thinking hard on the capital part. How will the capital flow into the country? That's the fourth leg of Mr. Modi's sort of intervention. He talked about laws. I suppose if the laws are opened up, in FPIs, in FDIs, in these areas, then the capital will flow. And to answer your question, sir, be it Ahmedabad, be it India, is a land of entrepreneurs. Entrepreneurs will look at these business opportunities. It's a new world we are going to enter into. Let this opportunity be recognized by the government and act fast. So all the three reforms, land you will need to do more production, labor reforms you will need, and you need laws. Liquidity is the only thing we have addressed so far. But we need laws also to make sure that there are proper contractual laws to meet with some of these obligations, basically. So I would say, sir, the hope is there. If the government has really come this way in articulating a vision, I would say they should really come out with, I'm hoping that they've come out with clarity on laws, first and foremost. And also, in regard to what are they going to give this opportunity of people moving from China to India. Yeah. Parekh, that was the answer that I would have thought I would put out in a larger scale, basically.
Okay, thank you.
Okay, we have another query from the line of Mr. Sanjeev Sasdev. Mr. Sanjeev, if you could unmute yourself and pose your query. Yeah, Mr. Sanjeev.
Mridul, there's a question from the question doc. Should I announce that?
Sure.
So there's a question which is saying, do you think the borrower behavior may be adversely impacted post the moratorium extended by banks and NBFCs?
Hello. Purusha, can you repeat the question, please? I think it's not clear.
Sure. Do you think the borrower behavior may be impacted adversely post the moratorium extended by banks and NBFCs?
I think this is closer to Jaspal.
The question says, do you think the borrower behavior may be adversely impacted post the moratorium extended by banks and NBFCs?
If I may just take a shot at this, what if I understand correctly, what the gentleman wants to know is whether the moratorium is going to impact the individual adversely. If a borrower has an outstanding loan and it wants to actually service it, but is the moratorium in terms of not making the payment today, but after 3 or 6 months time going to impact them adversely? My sense is that the economic answer to this would be that banks are not forcing the moratorium, are giving that as an option to the best of my understanding. And if the borrower has the capability to service the loan and avoid paying interest, because banks are not going to be able to waive interest for the period of the moratorium, and assume you have a expensive loan running, you want to run down the loan, then I think the option is to the borrower's side to be able to make the payments as they were pre-scheduled, as opposed to availing the moratorium. However, if the borrower agrees to take the moratorium, then we'll have to continue to service that interest over whenever the EMIs are scheduled. So that's my understanding, unless I've got the question wrong. That's my understanding, unless one of my panelists want to add.
Can I add, Ajay, on that?
Yes, please.
My feeling is the question is whether it will impact his credit score and whether it impact the credit rating.
Credit rating.
If somebody takes him, so if you, how you will look at it? Suppose one NBFC or one corporate is taking moratorium, and then how the rating agency will look at it that this guy has taken moratorium, That means he didn't have the capability or capacity to repay. I think for individuals already I think government has given some guidance to CIBIL, etc., even to rating agencies directly, indirectly. But finally, when you really do your job, it will come into your picture while giving a rating. Is it correct? That's the question. I think.
So if I want
Yeah,
to react,
but I'll tell you what, Ajay,
Yeah,
I think the question was more on the behavior, and I think the worst that can happen is the borrower starts believing that this is a loan mela.
oh,
You know,
okay. So let's
we've seen.
Yeah. Go ahead, Ashvin. Complete your thought.
No, so I'm saying, look, I mean, we've seen it in the, farmers. I mean, in the past, due to political, state elections, whatever, they start believing that you go and borrow from the banking system with a clear intent that you don't have to repay or whatever. If you're referring to the behavior of that nature, I suppose that has to be checked very clearly right in the beginning, I suppose.
Right. And just to add to that, what Ashwin said, if indeed the question is how it was interpreted by Mr. Bansal, then as a rating agency, I would just simply say that I'll refer to my comments that I made earlier about the post-COVID situation. This event is a once in a century or once in a half a century event. So considering the enormity of this damage to not just Indian economy but to global economy, I do not think that the moratorium should be held against any company or anyone for that matter, because the regulators have taken a certain view, and therefore to defeat that view and take a negative view of the person or entity availing the moratorium would perhaps not be right, given the exigency of this situation and the enormity of the damage that it has caused to the economy. That's my high-level comment. Obviously, specific situations will have to be dealt with specifically, but generic comment, I would like to make this.
Fine, sir. We have a query from the line of Mr. Jitendra Agarwal. Mr. Agarwal, I have unmuted you. Can you please go ahead with the query?
Yeah, thank you very much for giving an opportunity to ask this question. My question is to Bansal sir. Sir, I just want to know, wouldn't it be sensible to have a omnibus ICA in case of resolution, because we haven't seen the earlier June 7th circular ICA have ever worked until now. So my first question is, wouldn't it be sensible to have omnibus ICA? The second question is, because of the slow decision making from the banks, what do you think how the decision making can be improved? What the government can do to improve the decision making in the bank?
So I agree, Jitender. I mean, one option can be an omnibus ICA, which used to be the norm in CDR also. But today the atmosphere has become like, say, we have too many issues between lenders and between creditors, the security related issues, the priorities, and IBC has created further, I think, some confusion sometime. But I would agree with you that if you sign the ICA in advance for all the cases, and then you say it, that's what I was trying to tell in my this thing part also, that it should be mandatory. Today, for case to case, actually people then take position based on what is my position in that particular case, depending on security. So then that's why I take a decision accordingly whether I will sign or not. So that should not be left to the discretion of the lender in each case. And so that can happen automatically if we make it mandatory for all the cases, and you can sign an omnibus ICA like what CDR used to be there. And I feel in general, RBI need not modify, I mean, either if they want, they need not modify June 7th circular, or they can modify it, but they can issue another circular which allows to some extent restructuring in all the cases. Your second part is, how do we expedite decision making, and how do we ensure One option is you authorize the lead bank, maybe, which we have tried earlier, which can still be again tried, that you authorize the lead bank to take a decision on behalf of lenders, and at least the part of consortium in most of the cases. Then I think, even if public sector banks, they authorize one lead lender, that itself will take care of almost 70-75% exposure in most of the cases. And then if it reaches 75% anyway, the lead lender can take a decision on behalf of all. So it doesn't have to worry about smaller public sector banks.
Fair, sir. Thank you very much.
Okay.
Thank you, sir. Now we have a time for one more last question because we're running short of time. So I'll try to take this from the line of Mr. Ashok Mittal. Mr. Mittal, I'm trying to unmute you, please. Yeah. Hello. Yeah, Mr. Mittal, can you hear me? Hello. Yeah, Mr. Mittal, you can please go ahead. Hello. Hello. Yeah, I think now we can take a query from Mr. Amit Gulati. Sir, please go ahead. I've unmuted you.
Yeah, thanks. Can you hear me?
Yeah, sure.
Yes.
So yeah, the query is, we've heard time and again the moratorium thing being raised by the RBI and finance minister. So it's being given for 3 months and another extension. And now I think there's a realization coming in, which I heard by all the panelists, that possibly moratorium is not the answer and some one-time restructuring needs to be done on for the borrowers to be able to address this COVID crisis that has hit them. So my question to the panelists is that, given that so far banks have been pretty slow in terms of addressing restructuring for the corporate lender groups, how do you expect them to be, more time-bound, efficient, and uniform in carrying this out at the earliest to be able to address a problem which could haunt them in terms of a growing NPA in the banking sector?
Mr. Bansal, you want to take it?
Yeah. So basically, it will be in their own interest to do it, and otherwise they will be staring at a high level of NPA. But they will not do it unless you grant them some forbearance on NPA. As of now, RBI guidelines say that if you do a restructuring, it becomes NPA, except when you do in June 7 circular. And that too, June 7 circular virtually forces people to do a change of management, which doesn't happen in normally. So without change of management, Ajay doesn't give a rating. So that resolution, actually that restructuring never happens virtually. That is why June 7 circular, we have not seen anything. So I think either modify the June 7 or you allow one-time restructuring without making the cases in NPA. Then only the banks will do. Otherwise, perhaps banks will not do. But it is their own interest to reduce NPA and to do it.
If I may take just a minute to extend the question further to you, Mr. Bansal, that in case can each bank take its own view on this restructuring, or does it have to be led through the consortium lead manager, lead bank? Or will RBI be prudent to allow every lender to take a bilateral view of this restructuring with the customer?
What happens is, even if RBI allows that, unless other banks restructure, the restructuring will not work. Like say it is like, this moratorium in NBFC or other cases, why banks were not giving because they were worried that NBFCs will end up paying to NCD holders and other lenders, and banks will hold the baby finally, no? So it is the same thing. If I do a restructure as one lender, others don't do it, then others are getting priority payment over me.
Right. So therefore, this is more complex than we can imagine it to be.
So it can be done. That's what I am saying. So the ICA type system can help, and everyone will do restrict. Now, thankfully, the number of banks has come down, because anyway we always have a complaint against public sector bankers. So now their number is only 12. So as compared to 27 or whatever. Yeah.
Right. But I think the right way to do this, if I may take a shot at this before closing, is that RBI should put a date on this. Firstly, they have to agree to restructuring to be permitted. Secondly, if they permit that, then they have to put a date to it, so that banks don't take until forever to come together and make decisions. There should be literally a gun to their head saying you want to take the benefit of non-NPA, then you must do this by, let's say, 30th December or 30th September, as the case may be. Yeah, easy for us to deliberate how to get this done, but until there is a pressure like that, you don't want banks to take until forever and create problems for those that are willing also, as Mr. Bansal said. Back to you, Mridul.
Thank you, sir. Dear participants, now we'll close this session. For any feedback, suggestions, and queries, you are please welcome to respond in our suggestion and comment box, which will be coming no sooner the webinar ends. Thank you and goodbye for now.
Thank you all. I must thank all my panelists. I think it was very, very interesting, very insightful observations by Mr. Parekh, by Mr. Bindra, by Mr. Bansal. I really enjoyed the very wonderful deliberations we had. Also, some very good questions came our way. So thank you for being with us and having spent this much time with us. There is more coming tomorrow as well, and in the weeks to come. So stay clued in. Stay glued in. All right. So thank you again. Thank you very much.
Thank you. Thank you.